Good afternoon, everyone. My name's Tim Fortier. I'm the Communications Coordinator with New Hampshire Municipal Association, and thank you so much for joining us for this 2022 webinar series. Today's webinar is the economic update for local governments. We are joined today by Christopher Pelletier of Citizens Bank. Good afternoon, Chris.
Good afternoon.
Thank you for joining us, Chris. Appreciate your time. We also have Natch, our Government Affairs Counsel at NHMA. Good afternoon, Natch.
Good afternoon, Tim.
And Kathrine Heck, the Government Finance Advisor. Good afternoon, Kathrine.
Hello, Tim.
Thank you again, members, for joining us today. We will be starting the presentation with Chris. We ask that you hold off on your questions until the end of Chris's presentation today, and he'll be more than happy to answer the questions that you have for him. And we will be packaging this video or this presentation into a video recording, and that with the PowerPoint presentation, getting that out to you probably early part of next week, but we hope that you'll share these materials with your municipal colleagues and friends who couldn't join us today. If you do have any questions, we ask that you put that in the Q&A function. I will be distributing a economic conditions survey in hopes that you all will fill out this survey by the December deadline. And I'll be putting that in the chat line, but that is the only thing we'll be putting in the chat line today. So with that, I'd like to turn the program over to Kathrine Heck.
Thank you, Tim. Well, we're going to get started today with the economic update presented by Christopher Pelletier. He's the Managing Director of Citizens Global Markets Interest Rate Risk Management, and he's here today to give us our update on the economy. Chris is the Managing Director in the bank's Global Markets Group and leads a team which assists the bank's corporate clients in developing and executing interest rate risk management strategies. We welcome Chris, and we want to thank you and your team and Citizens Bank for providing our members with this important update on current economic conditions and trends. So with that, I'll turn it over to you, Chris.
Thank you, Kathrine. Good morning, everyone. So obviously interest rates have become a pretty hot topic over the past 12 months. Where we like to start the conversation is to look back to, basically over the past 5 to 7 years and how did we get here? So we look back to 2016 to 2020, right before the pandemic. And when we look at a number of major indices, including the unemployment rate, the 10-year Treasury yield, the Fed funds policy rate, essentially, and then things like CPI, we can see that everything was pretty balanced for that 5-year period, with unemployment actually sitting at all-time lows. And then all of a sudden we have the pandemic come in, and you can see pretty clearly where that started with the spike in unemployment, which jumped up to around 15% off that all-time low level. And so basically, that, as we all know, that sparked first the Trump administration and then the Biden administration to put through a bunch of fiscal policy changes and a ton of spending, $5 trillion roughly, to promote the economy. And then the Fed acted as well, cutting rates to zero and then also increasing the size of the balance sheet. And while those motions got everything back on track as far as the economy goes, we were left with a different problem, which is inflation. So that's the new hot topic over the past 6 months, and the thing that the Fed is very focused on bringing in. When we look over to the actual policy action, especially on the left-hand side of the screen, the Federal Reserve's balance sheet. So the Fed had kept around a $4.5 trillion balance sheet since the start of the 2008 crisis. It actually built up from $1 billion up to $4.5 trillion. The purpose of that program, called quantitative easing, is to basically the Fed to become a buyer in the Treasury market and mortgage-backed security market. And so as they become like this artificial buyer of securities, that flushes the market with cash and drives down long-term yields. So it's very stimulative to the economy. And so they were never really able to get out of the 2008 QE program. You could see that even before the crisis, they only took it down just a bit, right at the inception, basically. And then all of a sudden COVID comes in, and now they take it up to 8 trillion and then eventually went up to 9 trillion. So think of that as having all this like artificial money floating around the economy. And as a result, the economy got back on track very quickly, especially when you think about that combined with the fiscal stimulus programs, which are shown on the right-hand side of the screen. However, with all that extra money in the economy, people were happy, everyone has jobs, wages started growing, people started spending money. And we also had supply chain disruptions, which also affected prices as well. So when you put all that stuff together, people in an economy with a ton of extra cash and then supply chain issues, all of a sudden you have inflation. And so the Fed typically tries to keep inflation around 2%. And so when you're hearing about CPI at 8%, that's not a very comfortable level. And the committee is very concerned about that, staying at these levels or rising. So as a result, they started to change policy mid-year this year. So when we think about inflation, there's really three major metrics that people focus on. We are probably all most focused on CPI and PPI. However, the Fed likes to focus on something called personal consumption, or PCE. Excuse me. So that's the rate that they're talking about when they want to get back down to 2%. And those metrics right now are floating around 6%. So while you have CPI at 8%, they're really looking for around a 4% decline in the PCE figure. And we could see here on the right side of this chart that PPI has come in quite a bit, which should translate eventually into lowering CPI as well, but there's been obviously a bit of delay there. I think what's interesting here too is that we all, some of us may remember, or some of us may have heard about the high inflation levels from either the mid 70s, early 80s, and you can just see how high we are today relative to the 90s, 2000s, and 2010s. That's why there's so much focus on this metric at this point, and that's why the Fed's uncomfortable with current levels. So when we think about inflation, and particularly we're looking at CPI here, which is the gray shaded area in the back of the chart. You got to compare that to what was the Fed doing, or where was rate policy being set versus that high CPI levels. And what's interesting is looking at this chart. So at every point prior to the crisis, and even some thereafter, the Fed has kept its policy rate, which is the dark blue line, above inflation. And so by that nature, you could almost argue that the Fed funds rate has to be much higher today in order to bring in inflation. That's really what the Fed's trying to feel out. There's no easy recipe here because there's a lot of moving parts. And what's also complicating things is the situation in Ukraine and Russia. It's affecting energy prices. It's affecting, just people's overall sentiment around the market. So it's not like there's an easy playbook here, but one interesting thing to point out is where rates were sitting in the past relative to inflation levels. So if we look back to the early 80s, that was when Paul Volcker was the head of the Fed. And as some might recall, he put policy to 20% for interest rates in order to reel in inflation from around 15%. And today we're sitting with inflation or CPI at around 8%. And we have a Fed policy rate of around just over 3% at this point. And so the question then becomes, is that the right level? Does it need to be higher? Does it need to be lower? And the frank answer is, I don't think anyone really knows at this point. There's just way too much uncertainty. There's been a ton of volatility in the market, and you can see intraday swings of 1/4 of a point, which is pretty amazing. I mean, that's by far the most volatile point in time I've seen in my career. You could see that on a day when some major news breaks, but these are day-to-day swings based on one incoming data point that might have missed the target. And so anytime that we're seeing that inflation is showing lower than expected, we see a pretty sharp decline in interest rates. And then conversely, if these inflation metrics are showing higher than expected, we see it pop the other way. So a ton of volatility. And I think that this chart just goes to show you that there's at least the option that the Fed might have to tighten it quite a bit more in order to bring inflation to target levels. So next up, we look at energy prices. And I just touched on that briefly with the whole situation with Russia and Ukraine. And this is also a driving force for inflation as well, because besides the supply chain disruptions, a lot of oil fields, for example, were shut down during the crisis, or people might remember that point in time where for a day, oil actually traded at a negative value, which means suppliers were paying people to take their oil because they had nowhere to put it. And so when you shut down a well like that, it can take a while to bring it back up online. And so when the demand came back, the supply wasn't there. And so that's part of the reason why prices started rising. And then we can see this point in, excuse me, it's actually March of 2022 when Russia attacked Ukraine. And then we can see there's an even bigger disruption there and almost an acceleration in prices at that point. And so at this point, we're we've gotten back off those levels, but we have a new factor where OPEC is now reducing supply to basically push prices up again. So again, this is why central banks like the Fed and the ECB, Bank of England, are having a tough time. Well, their job's not easy because there's so many factors that are driving their decision making. It's just not there's no clear answer here. So next we look at something called the Fed's dot plot. And so this is something that the Fed has released quarterly since 2015 in order to tell or indicate to the market where the committee members believe that they will be setting policy over time. And so we're looking at a couple different versions here. So the yellow dots on the screen are actually the votes of the individual committee members. So there's 16 of them in total. And we can see for the end of 22, as of the September Fed meeting, that one member on the low side believed that the Fed should be setting policy at 3.875%, which is about one additional rate hike this year. And then on the other side, there's a member that believes that the policy rate should be at 4.625. So arguing for even more hikes. Because the disparity between the committee members' opinions, the market tends to focus on the median expectation. And so now the median expectation is to end the year at 4.375%. And so the market's been tracking about 2 additional 75 BIP hikes by the end of this year. The first of which is expected to come next week at the November 2nd Fed meeting. That's pretty widely baked in. It's 100% priced in at this point. The point that keeps moving around is the December implied number. How much is the Fed going to raise rates in December, and will they have to? So as of right now, signs are that they will need to, and the market's pricing a 50 basis point interest rate hike for the December 14th meeting. Just days ago, that was pricing at a 75 basis point hike, which again speaks to the volatility in the market, and that a couple of soft data points can all of a sudden take a rate hike out of expectations. When we look out into the future, the committee is basically from a median expectation perspective. If we're looking at these yellow dots, looking at that green line, the committee is expecting about one additional 25 basis point hike in 23. And then they are actually expecting to cut rates in 2024. And the premise there is that the committee believes that through this series of 75 basis point rate hikes, which are outsized relative to the pace that the Fed usually raises rates at, usually 25 bips each time, they believe that they are going to stifle out inflation pretty quickly, and that they may be going at a pace where they might create a little bit of a softening in the economy. They're hoping for what's called a soft landing, where everything kind of just ends up smoothly, but we all can probably figure out that's probably could be unlikely given the number of factors involved. And so the committee agrees that, this series of rate hikes will bring down inflation, but there will be a consideration, and maybe unemployment starts to move higher, wage growth starts to move lower. So there will be some impact. And as a result, the current expectation is that the Fed is expecting a series of small cuts in 2024. And their long-term goal is, according to this chart, and it always has been clearly, is to get the Fed funds policy rate back to 2.5%. Now that might seem, I don't know if that seems high or low to people, but I would just remind people that we had zero rates for a very long time between 2009 and 2015, and then again for about a year during the COVID crisis. So depending on how you look at things, that's a high level relative to where rates have been over the past couple of years, but it's a very low level when you think back long term, where rates have actually averaged closer to 4.5%. So next up, we're showing the Fed's summary of economic projections, or the SEP. So this is something that they release quarterly. So this is not my own view on where things are going to land in the next couple of years. This is the Fed's own economists and what they're projecting. So when you're thinking about budgeting or any kind of thing about long-term rates or where the economy is going, this is some of the best and brightest putting out their projections. And so top left, we're showing the data that gets back to that median expectation of the 2.5% for the Fed funds target rate. That's what we were just looking at on the dot plot. We can see long-term GDP expectations 1.8%. And then probably what people might be more focused on is inflation. This is the lower left corner, the PCE deflator. So we can see that Currently, it's around 5.4%. We know that they want to get back to 2.5%, 2%. And this chart is showing that they're expecting that to return, by 2024 or so. So that's again, the metric that the Fed is focused on. It's a little less so on CPI and PPI and more focused on PCE. And the last thing to look at is the unemployment rate. So we said that the unemployment rate was at all-time lows leading into the crisis. It's back there now. However, you can see that for 2023 and 2024, the Fed is expecting a rise in unemployment. And again, that's the collateral damage, so to speak, of the Fed raising rates aggressively in order to stifle inflation. You can't have a win across the board. So they're willing to tolerate higher unemployment in order to bring inflation back into the target range. So next up is actually a floating index that I look at very closely because the corporate borrowers that I work with are actually paying this interest rate, or this is one of the interest rates or floating indices that are used on corporate debt. It's called 1 month term SOFR. And SOFR is a new rate. It's really come around just this year as a replacement to LIBOR, another rate that people might be familiar with. But why we like looking at this chart is because SOFR tracks very closely to Fed funds. And in fact, will move in line when the Fed makes an adjustment. SOFR is going to jump as well. But what we can look at here is what the market is actually expecting for futures in SOFR, which is going to be very closely related to what the market expects for Fed funds. And so we talked about a few minutes ago, the Fed will continue to raise rates into the end of this year. The expectation is they have another rate hike in early 2023. And if you look at the green line here at the top of the page, this is as of October 21st. As of that date, you can see that the market was believing that Fed funds, term SOFR would peak out around 5%. And so that was I think that was one of the recent higher points. I think we're a little bit off, below that level at this point in time, but you can see very clearly there what the market is expecting for policy adjustments. So we have about 1.5% of hikes into, or maybe 1.75% of hikes into the spring. And that makes sense, right? We're 75 basis points next week at the November meeting. 75 bips more was priced in at that point for the December meeting, and then 25, I think, for February. That was really the path that we're looking at. And then you can see the progression that the market's pricing for cuts into late 2024. It happens pretty gradually. And again, that's the assumption that the Fed will have to cut rates because they will have over tightened the economy. The other amazing thing to look at is the two lines below that. So the bottom blue dotted line is that same curve as of January 1st. And so at that time, the market was expecting no rate hikes from the Fed until 2024. And then again, we show, and I'm sorry, let me take a step back there. So that was the point in time where the Fed was arguing that inflation, the rising inflation in the economy was transitory. It was due to supply chain disruptions and would be dissipating at some point. And they had just started to acknowledge that, hey, maybe this thing's here to stay. We need to start doing something. And that's why it was a very flat curve with very little rate hikes priced in. By the time we got to this middle point, which is August 1st, which was the recent low, rates had spiked up into June, come back down for August, and then have spiked up since then. But we see a very different curve where instead of ending the year at 1% Fed funds rate, we're looking at 3.125 was the expectation, and again with a dip into 2024, and then here we are, a couple months later, where the high for the expectation is now 5%. So this goes to show you how volatile things are. How much things can change. And really that was a result of two things. First, inflation wasn't kicking back. The Fed's already implemented 3% of rate increases this year, and we're not seeing a matched decline in inflation. And then on top of that, the Fed came out with some powerful language saying, we know that our rate hikes are affecting the equity market to the downside, and we're not really bothered by that. We understand that tightening the economy is going to push up unemployment, and we're not really bothered by that because our main mission is to stamp out inflation. And so by the Fed saying that we're not gonna pause as a result of one of these other indices going in the wrong direction, it made things very clear that as long as inflation is staying at current levels, the Fed will be acting. And that's why we've seen this pretty big ramp up over the past couple of months. So then we get into what should we all be looking at as we try to figure out the Fed's next move? And we're not saying encouraging any kind of speculation by any means, but really we have a few things. So we have the balance sheet, that's the gray shaded area in the background. Again, $9 trillion, and you might be able to see there's a very slight decline that has started to occur recently. The Fed has halted reinvesting in some of the bond holdings, and so basically that's taking cash out of the economy. And so when we think about bond economics, if they are no longer playing in that market, that's going to put downward pressure on prices and upward pressure on yields. And so that's what they want. They want to start normalizing that piece. The next thing to look at is the CPI figure, and more importantly, the PCE number, which is not on here. But as long as we continue to see those levels, PCE around 5-6% or CPI around 8%, we're going to continue to see the Fed act. There will no delay to Fed policy, so they implemented the first rate hike back in March, and it's hard to tell whether we're really seeing that just yet. You can see here in the top right corner of this graph, there has been a decline in CPI, from 9% down to 8%, but that's not that. I wouldn't say that's equivalent to the 3% of increases the Fed's already put in. So then the question is there a delay there that we're not seeing yet? And I think that's one of the arguments in the economy, that the Fed won't know that it has over tightened until it's too late. And that's one of the arguments why you see at times rates falling quite a bit, because data comes in saying, hey, the economy actually is softening. Maybe the Fed's going too much. But as long as we see inflation at those levels, and we're seeing unemployment within tolerable levels, which the Fed just showed us in their projections, that's probably below 5%, we're going to see a pretty tight economy. The question then is, when does this all start to change? One interesting point is I said early on in the conversation that just a week ago, the market was pricing a 75 basis point rate hike for the December Fed meeting, and that's fallen off. Part of why that's occurred is that Fed President Daly made some comments late last week that the Fed is concerned about over tightening and is going to, try to pause and slow things at the right time. And that, people are waiting for the signal from the Fed that they're ready to start slowing the 75 basis point increase they've been doing for some time now. And so I think everyone's so eager to jump on that and see things normalize and, kind of reinforce equities, that you see these pretty big points of volatility at times. So that's led into the downturn in rates just over the past week, where, essentially a rate hike has been taken out of the 2022 calendar at this point in time. But it's really been an interesting year. Unfortunately, there's no real certainty on what happens from here. I think we all just need to continue to watch the data, and it's good to have an understanding of, when this data point comes in, what does that mean for the Fed? How are they going to react to that? Because then you can start to see the path forward of, if we see inflation, lingering around 6% for PCE, the Fed will continue to raise rates. If we see that drop significantly and unexpectedly, you might actually see some cuts come in a bit faster. So I would definitely suggest, keeping an eye on those points: unemployment rate, those major inflation indices, and then obviously you got to watch things like equities as well. The Fed's been pretty adamant that they're not going to react to a downturn in an asset class like housing or equities, but at some point they may have to. So those are the main things I'd be watching for as you're trying to evaluate the budgeting process and the future interest rate exposure. Thank you. And so with that, we can we're happy to take some questions, or if there are any in the chat.
Yes, Chris, thank you so much. That was an excellent presentation. I do have one question for you. The question is, when talking about unemployment as a contributing variable, is there any allowance for the gig economy participants that have not returned to the traditional employment market? Do you have any thoughts on that?
I don't know the hard data answer to that question, but I was traveling yesterday, and I was in an Uber, and the driver was talking to me and was telling me he cannot get a loan because he's an Uber driver. So there's some element where, there are definitely some jobs that are not considered by some people a real job like those of us all have. And so the question then is, I don't quite have a hard answer on that, but it's definitely a thing that's grown over the past decade. We know that we have various forms of employment that, these gig jobs. And the question is, how does that factor into this whole thing? And yeah, that's a tough thing to answer, unfortunately. I think also, the BLS data has always been kind of questioned about, how accurate that number, what's the labor participation rate look like? There is this element of, uncertainty in those numbers, but I think the important part to focus on is the consistency of how it's measured. And so no matter what, it should be still getting a pretty accurate read on the economy, even if it, has some slight variance to it.
Thank you. Well, that's the only question that we received. However, if people feel like they have more questions after thinking about Chris's presentation, Natch and I have provided our email addresses. You can reach out to us. We certainly have your contact information as well. You can continue to put them in the chat, and we'll be happy to try to answer your questions. And now we're going to, I do have one more question, Chris. I'm glad you stayed on.
Okay.
I apologize. It just came in. I'm sure they're typing. The question is, do you have any predictions as to what the 20-year bond rate will be over the next 2 years?
No, and that's just given the uncertainty in the market. But yeah, I think that's been a tough. I don't think anyone really predicted that the 10-year would be at 4% as it is now. That's what makes that game pretty difficult. I think the data is going to lead us down that track, and I think the incoming data has been so volatile. It's just a really difficult answer to form, unfortunately. So,
well, thank you again, Chris. We really appreciate your time. And at this point, I will turn over the next portion of the presentation, which is based on the New Hampshire policy and economic conditions in our state, to Natch Graves.
Well, thank you, Kathrine. I'm happy to drill down a little bit on what's happening in New Hampshire. So really, municipal budgets are facing dual challenges here. First, inflation is obviously rocketing costs. We're having a big impact on anything from materials to your labor costs to things you're kind of purchasing incidentally, as well as some of those core items. So incidental items, you might be purchasing food for whatever thing you're hosting, and then of course energy. This is one of the big factors for New Hampshire. And we're also seeing it having a big impact on things that are sort of tangentially affecting municipalities. So housing is probably the big one here. And based on what the data is showing us, it looks like at least until spring 2023, we're going to see some pretty high inflation. And that's going to be something that you're going to have to price into your budget. The other big challenge is that taxpayers' real earnings are down. So that's going to really impact their willingness to come to town meeting and vote for any kind of increase. In fact, just based on my experience with town meetings, you always have that group of people who come in and want to cut the budget. You're probably going to have a larger portion of those people this year based on what they're seeing in their own lives. So as Chris pointed out, one of the things that we look at first and foremost is the consumer price index. And we've seen that really spike since the beginning of, or I guess mid part of 2000. And one of the big challenges with this, of course, is that it compounds. So it's not that, it's going up 8% this year and prices are going to fall back to a normal, 8% lower next year. It's the case that it's now everything costs 8% higher when you spread it out across the board. And that's been a big challenge because we saw a higher inflation rate last year. Kathrine and I did a webinar on that that I think many of you attended as that was starting to come to the fore. And we're seeing that throughout this year as well. And it's really hard to predict what's going to happen in 2023, but it's very likely we're going to continue to see some increase of across the board there. And it's really having serious impacts across the economy here. One of the main things that you are probably looking at now as you're planning your municipal budget is the producer price index, which is the average change over time in the selling prices versus what they can purchase the raw materials for. And it is, as you see, it's that gray line on the it's a combination of these various lines, and they're being impacted by a number of things as well. So you've seen energy spike. Chris gave a good overview of what's happening in that, and I'm going to delve into that a little bit more. But we've seen goods and services spike as well because of those logistical challenges. We're really seeing pretty significant problems happening as well with those costs. And so probably one of the biggest expenses that you're going to see in your communities, that you're going to hear about in your communities in the next couple of months, is winter heating costs. And so EIA does a prediction every year of how much heating is going to cost for winter compared to last year. And they base that really on NOAA's estimates of what the heating degree days are. And that's a formula that basically calculates how much energy is needed to be put into kind of any sort of heating source in order to keep the temperature reasonable in a building. And so that varies year to year. On the left side here, you see that bar chart, and NOAA is fairly accurate when it comes to predicting what the heating degree days are going to be. Generally, the median line doesn't vary too much. We are seeing more variation now than we used to, simply because of climate change happening. But one of the things that EIA does is they put a bar around that. And so there's a 10% if it's colder than expected by 10%, or warmer than expected by 10%. And they give a nice area that over time you can see has pretty much shown you the variance in what those costs are going to be. And so overall costs have expanded pretty significantly. And so you see that on the right with the change from last winter, what that additional cost will be for average US households as compared to last winter for the predicted amount, as well as 10% colder and 10% warmer. And that's really translates, of course, into municipal costs as well. So you're going to be paying more to heat your buildings over the course of the winter. And the big thing that has really been impacted is natural gas. One of the things to know about New Hampshire and how we provide heat and energy to our buildings is we rely pretty heavily on heating oil. That's not very common throughout the United States, but it is something that many of our residents do purchase. It's more common in Maine than in New Hampshire, but virtually all heating oil is used in New England. So we've seen that, and in the past couple of days, there have been a couple of articles about the availability of heating oil is really decreasing, and that's driving the price up even more than it has been, but it's really been in flux. One of the other big costs we have is natural gas, and we primarily use liquefied natural gas in order to fuel our electricity generation. So even though you're seeing EIA's predictions at about a 10% increase for electricity costs, anyone who's already received their bills from Eversource or who are about to receive their bills from Unitil know that that's a significant increase that we're seeing across the board. And that's because about 53%, 54% of the electricity in New Hampshire comes from liquefied natural gas. And by New Hampshire, I actually mean our regional distribution, because of course, many of you are thinking, well, doesn't the nuclear plant out on the seacoast kick in a lot of our electricity? It does, but we fall under a regional capture for electricity, and therefore it doesn't all the electrons go into the grid, and it's really hard to trace where they go. So it's basically kind of grid by grid is what we're talking about. So in terms of what we're seeing for heating averages, and these are updated every month, we're seeing some pretty significant increases in costs compared to last year across New Hampshire. So we're seeing, 28 cents to 34 cents or so per kilowatt hour for electric costs. We're seeing the costs for things like biomass has increased. That's wood. Of course, that has gone up because many people in our state do have alternative heat sources, wood stoves, et cetera, in their houses, and they're looking to those because they're cheaper than what they traditionally use. And as costs go up with those, they're having to figure out those costs as well. And to some extent, that's impacting motor fuel costs, but that is on a much larger, really global scale. So we don't really see as much of a changeover when it gets cold with those as we do elsewhere. And one of the things we really wanted to try to show as much as it is possible to do so is the trends over time with some of these energy costs. So you're seeing the EIA's information about on the left-hand side for electric costs, and the right-hand side natural gas prices, and they go through really these undulating loops. So in winter, they obviously cost more, summer it's cheaper. And it's really been pretty variable over the past couple of months as Europe has really dealt with the issue of how they're going to fuel their own heating needs over winter. And one of the things that has been a huge impact is, of course, since we rely on liquefied natural gas, Europe has also used that pretty extensively now that they're cut off from the Russian pipeline has been cut. And so that's mostly what they're burning. So really it becomes a contest between who's willing to pay more, and that's where the ships go. So that has become really problematic in terms of the ability to predict prices. Over the past couple of weeks, we've seen those gas prices go down, but that's not to say they're going to continue to go down. They seem to have stabilized between the $3.50 and $4 mark for per gallon, but we'll see exactly how that works out. And in terms of the actual fuels, I have a slide here that shows you some of the average prices across New Hampshire. And as you can see, these are pretty high. Fuel oil especially, it's well over $5 a gallon. Propane is just below $4 a gallon. And of course, last year, both of those were right around $3 a gallon. Kerosene, not very common for heating, but it is used in some instances. That's well over $6 a gallon. Again, it's becoming quite expensive. And if you've received any of the mailers that any of the energy companies have sent out over the past couple months, you probably know that there are a lot of people in New Hampshire really trying to figure out how they're going to pay for that. And that's going to impact their ability to do things like pay their December tax bill. So that's something that you need to start planning for at the municipal level in case you start to see higher rates of non-payment than usual, because when people think about what they're prioritizing, heating their house versus paying a tax bill, the heating the house is realistically going to win out. It's one of the basic necessities to living here is having some sort of adequate heat along with food. So those are really going to be the priorities as people cut back. We've also seen a pretty big increase in our local energy costs and one of the electricity costs. And one of the things that we've been asked a few times is, well, how does that look going into the future? Is 2023 going to be any lower? Is this just a temporary thing due to what's happening in Ukraine and other pressures from OPEC and other organizations that control some of the energy supply? And the answer is it's really hard to tell. Probably the case is that the average electricity cost that we've seen over the last 7 or 8 years pre-pandemic are probably lower than what we're going to see going forward. EIA actually just released some information today, and I believe the UN released some information yesterday that indicates it really looks like we're at a point in time when we're shifting exactly what type of fuels we're going to be using and the costs associated with them. And as really the battle between, I guess I'm going to call it the battle between renewables and fossil fuels happens, you're really going to see some costs associated with different policies at the national and international level that are going to be essentially paid for by everyone at the local level. And it's going to be really hard to figure out over the next 5 years or so what those costs are going to be, except that we're probably seeing some of the costs relatively close to what we're going to see going forward. So I only have more bad news because this is economics, the dismal science. So the cost of building is getting cheaper, but not by much. And so one of the things that municipalities have been looking at across the board is things like housing, as well as sort of that new revenue that new housing is driving in the form of increased prices and additional tax revenue for developed properties versus undeveloped properties. And we saw at the beginning of the pandemic, really the drop off in logistics really caused prices for the goods that go into construction to skyrocket. And those prices have moderated it somewhat. And we keep seeing information that those prices are going down and they are decreasing by pretty significant amounts. But they've also increased so significantly that the decreases aren't making much of an impact at this point in time. So just the cost to build a 3-bedroom house now as compared to 2019, you're looking at 3 times the cost in materials alone. And even when we're seeing significant decreases in costs in some of those inputs, whether that's lumber, whether that's steel, whether that's going to be iron or anything like that, it's not going to have that big of an impact on the cost to build. And so that's going to continue to cause your capital projects to increase in costs. And we're starting to see that reflected really effectively in the municipal cost index. And that's probably the best measure for what you need to look at as a municipality for your costs, because it builds in all of those things that you do as a municipality, that, road maintenance, those capital costs, labor costs, et cetera, are built more into that than something like CPI, because that's measuring the costs for residents. And unfortunately, one of the things we're seeing with the municipal cost index is that is pretty high compared to everything else. It's not as high as the producer price index, but it is higher than CPI. It's higher than just the construction cost index. So running a municipality essentially to provide the same services is much more expensive this year than it has been in the past. And unfortunately, what that means is that when it comes time to town meeting, and Kathrine's going to cover this in much more detail than I am, there are going to be some really hard questions you're going to have to ask, which is, are we going to try to provide the same services as before, or are we going to have to prioritize some service on what are people in town willing to pay? And unfortunately, there's probably not a lot of room in what they're willing to pay. So one of the things we've also been seeing is that as the interest rates increase, and those are the interest rates that that Chris was talking about before, that's going to impact what the average person can borrow at as well. And so when we look at something like home payments, we're seeing the same house with the same price, and I just based I just took this information from some of the housing groups. At a $400,000 house with a 5% down payment, you're looking at the cost per month increases pretty significantly as you go from the interest rates of a year ago at 3.1% to what we were seeing this summer at 5.5%. And now we've seen in the past couple of weeks, the average rate for a fixed mortgage has jumped to over 7%. And that's just the mortgage payment we're looking at here. It's not including property taxes, it's not including homeowners insurance, it's not including PMI. So this is important for you to keep in mind as you're setting your municipal budgets, because even if you're having the luck of having an influx of people move into town or a lot of churn, most of those people are going to be less able to absorb increased costs than they would have been had we been talking about, kind of your same population from 2 years ago even. And that's going to probably have a big impact on their willingness to look at things like increasing property taxes to maintain the level of services that have been historically given to them at their municipality. Kind of in conjunction with this, we're seeing home sales softening across the state, and that really makes sense because, of course, as the sales price climb, which they are still climbing, as those climb, as interest rates climb, it's becoming much, much more expensive to purchase a home. So we're really starting to see the market and home sales soften. If we think back to 2008 and prior to that in the early 90s, that's going to have a pretty significant impact on, could have a pretty significant impact on people's ability to continue to keep up with these additional costs. And we're seeing the same thing on the rental side as well. And this has been trailing the home sales increases, not necessarily by a full year, but pretty closely. Some new data was released late yesterday that indicates that New Hampshire, we've seen about a 20% increase in the median rent over the past year. That's keeping in line with kind of the 20% increase in home values that we saw about a year ago. And we've really seen a pretty significant jump since 2019 in what those median gross rents are. And I thought I had another slide here, but but that's something that we're probably going to continue to see in the future as well. As our home prices rise, we're going to see median gross rents increase as well. And that's going to put pressure on the municipal bottom line, particularly in the form of employee costs, labor costs, because already, if they can't afford to buy the house, it's going to be hard to hire people because you're looking at a smaller set of people, the set that's probably looking to rent in or around your municipality. And obviously, if those costs are going up at some point, those are starting to outstrip the ability to pay them. And that's going to have a significant impact on their ability to become an employee for the municipality. And that's going to put greater pressure on wages than already exist. And I know that many of you have contacted us and said the same thing, which is that hiring is really hard because of the availability of houses, because of the costs of those at the moment. And that's kind of all of that combined is one of the things that we're seeing is a lot of talk about the increase in wages and how that has affected additional costs as well. And one of the unfortunate things at the moment is that wage growth is occurring, but it's not occurring in the sense of allowing people to purchase more or even maintain the level of purchasing that they had before. So on the left here, you see the over a period of about 5 years, the increase in real average hourly and weekly earnings across private sector employees. So caveat there. And you saw a pretty big increase in 2020 and 2021 in terms of actual dollars people were taking home. This was that movement you saw a few months ago, even, that people were quitting, taking different jobs at much higher salaries. But as that data was tracked through the Bureau of Labor Statistics, even though people were making more money, it wasn't actually equating to their purchasing power increasing. And that's, of course, because of inflation. And so when you split that down between high skill, low skill, and mid skill workers, you see the same type of information across the board, which is, yeah, they've seen some pretty big increases in salary on average over the past couple of years. This year touched right around 6%. But in terms of their actual purchasing ability, you see that on the left, that's decreased by about 2%, 2.5%. So even as employers across the board are trying to pay their workers more, those aren't keeping up with inflation, and that's putting even more pressure on individuals to make choices about what they're spending money on, and that's going to impact kind of the bottom line here for municipalities. And in local government, we're seeing some pretty stark employment trends. So local government employment rates haven't recovered from pre-pandemic levels. So there was a pretty significant cut in local government employees during the pandemic. And unfortunately, it's been the case that New Hampshire, like most of the country, one of the largest employers is government. And New Hampshire isn't really outside the box here. We actually have a much fairly lower percentage of people who work for government, whether it's state, federal, or local level. It's about 13.4%. Nationwide, the average is 15.4 with a range from 13 to 25. So we're pretty close to the low end on that. But the number of government workers in New Hampshire has decreased in recent years. And if you've seen any information from New Hampshire DOT recently, they put out a call for anyone who has a CDL to come and work for them for snow plowing at the state level. And that's going to cause some decreases in availability of state employees and state functions over the course of winter because they simply don't have the people to plow snow. So they're pulling from other state government agencies and undoubtedly have been contacting municipalities as well, which means there's going to be greater pressure on municipalities to do some of what the state does, depending exactly where those workers are being pulled from. And unfortunately, that's going to create an even greater disparity than we're already seeing for governmental services. And I just had some statistics here on, our population, our median household income. And one of the surprising things is we actually saw an increase in median household income over the course of the pandemic. But even though that's the case, we aren't quite keeping up with inflation. So it's not all bad news. It's actually our average rate is just below inflation at 7.1%. But again, it depends on where you are in the state. The Southeast quadrant really is seeing the most increase in median household income, in line with the fact that most of the people there commute into Boston, or many of them, I should say, not most of them, commute into Boston and other areas that just have generally higher wages than you see up in the North Country, which is less populated. And that's going to create a bit of a disparity when you're looking at what you can do as a municipality in terms of what you might be able to, the choices you're going to have to make in terms of your budgeting process. So those of you in the Southeast particularly might be able to continue to provide the same services and really focus on providing the same services. Whereas if you're in the North Country, the cost of everything having gone up, it might be the case that you're looking at prioritizing what services you provide in a much more dire situation than elsewhere. So where are we headed? That's the question that everyone wants to know, particularly as we look at the fact that it's going to be the state budget cycle next legislative session, when we're looking at kind of what costs are now baked into the goods and services that were being provided and we are providing. And really, it's quite hard to tell where we're going to be going. I'm guessing you got that from Chris's presentation as well. So I hate to say the same thing here, but we do know that inflation is going to continue. We're going to see pretty significant impacts from what the Fed decides to do. And that's really going to help guide us where we go. And at this point, no one's really sure if we're going to have a soft landing or not. One thing we can say, that at least in the immediate future, is the interest rates are likely to continue to rise. So it's probably not a great year to borrow if you don't have to. Looking at the data that Chris provided earlier, it's probably the case that 2023, 2024 are going to be much more favorable in terms of interest rates. It may be the case that you'll be looking at refinancing those in the future. And we're going to see continued pressure kind of outside of the normal economic cycle on things like rent, because there are companies out there that have now focused on things like rent and apartment affordability. So one of those, ProPublica just did a series on, and which really shows that apartment rents across the board have gone up pretty significantly, even as we've seen the overall economy indicate that it might be softening a bit. And when I went to that company's webpage to learn some more about it, I learned that they were happy to report that market rate apartment renters signing leases so far in 2020 are spending only 23.2% of their income towards rent, still well below the traditional affordability ceiling of 33%. And they had some other articles about how landlords could really target higher income individuals because they were more able to absorb increased costs in rent. And so we're going to see some of those pressures sort of filter down through the market and affect municipalities, not only in terms of what funds people have available to put into your local economy, into your local budgets, but also affect kind of what's driving what's being built, what's being proposed in your town. It's going to have a pretty broad impact across the board. And one thing we can say is I think it's pretty reasonable to expect that inflation is going to stay well above the Fed's target for a while now. So this Bloomberg Economics did a analysis that they released about a week ago, where they think we're headed. It's pretty similar to what you saw Chris present, but a little bit different. Their numbers are a little bit higher as well. And so in summary, I just want to say that, inflation is going to increase the short and long-term costs of what we're looking at when we're looking to purchase anything. It's really hard to say at this point in time how that's going to affect something like the state budget. We've seen some softening in some areas like the tourism numbers, but we're still at target level with those. And because there's so much extra money in the economy at the moment, which Chris went into some detail on, it's really the case that some of the spending decisions being made at the municipal level are going to contribute to rising costs in specific areas or industries. So we saw that with something like broadband deployment. There was a lot of broadband monies available over the past year. I think the shovel-ready communities ended up getting some of those contracts, some of that deployment happening. Some of the communities that needed more time to put projects together saw that the labor costs were much higher. I heard from at least one municipality that one of the available companies was really putting pressure on them to sign a contract, or they were going to go out to some place like Minnesota, because of course every community across the entire nation has really, when you look at like ARPA and some of that other federal funding, are looking at the same types of projects, which is causing significant decreases in the availability of certain supplies and significant increases when you can find them, because much like those tankers out in the Atlantic, if Europe's paying more, and in this case, if Minnesota's paying more, that's where they're going, rather than New Hampshire. So with that, if anybody has any questions, I'm happy to take those.
Thank you, Natch. I do have one question. The question is, what is happening around the state to encourage affordable housing development at the state and local level?
So that's a really tough question, because realistically, it requires a number of things to come together. It requires kind of the right conditions for affordable housing. So when we're talking about affordable housing, we're talking about usually a pretty high density. So, a number of dwelling units on the same lot or otherwise clustered close together, probably provided with public water or sewer, because septic is expensive and wells are expensive and require a minimum lot size. So realistically, that's what we're looking at in terms of housing. And coupled with that, you need it to be the materials and the labor to be there for that to get built. It's something I've talked with some developers about recently. And in the case of what they're going to build, it's going to depend on market demand. So if you look at some place like Concord, where I live, there was a project proposed for the old, Concord Monitor kind of forest, we'll call it, because they owned a big tract of forest along the Merrimack River. And recently the proposal came in to change what was going to be built, because the demand wasn't there for as high a density. And so instead, some of the denser and therefore less costly dwelling units were being changed into single family homes, because that's what the developers determined that people wanted. And so in terms of that, one of the things they're looking at is material costs. So when you're talking about the cost of materials doubling, tripling, quadrupling, a house that would have cost $100,000 to build is now costing $400,000. It's not quite that dire, but it is the case that you're seeing the same houses, literally the same houses, just being built on different lots next to one another, as I've seen down the road from me over the course of a several year period, have vastly different prices. And so the governor has launched the Affordable Housing Grant Program that has been putting out some money to help encourage more affordable housing. And there have been some legislative changes to sort of the local zoning and planning board process in the last legislative session that have changed some of the processes and may or may not make it therefore a little bit cheaper to build. And it's very likely we're going to see some future legislation, potentially future monies given for this particular issue, but we're not quite there yet where we know what's going to happen.
Thank you, Natch. There was another question. All the copies of the presentations and this recording will be provided. And I will get into all the different indices as this other question asks where we could get it. And one is available by a free membership through American County Magazine. And we'll talk about that through my presentation. Can you see my screen okay, Natch, with the budget slide on it?
I can, yes.
Okay, great. So if there's no more questions, I'm going to get started on my portion of the presentation, which is to talk more about budget specific considerations. Well, I would have enjoyed talking about the charts and graphs tremendously. Natch handles a lot of our policy here at NHMA, and I'm going to get into some of the tools and resources that we can use as we prepare our municipal budgets. So I don't need to recover what Chris and Natch went over, but I will tell you that while New Hampshire relies heavily on local property tax, you're going to read in the papers that other states are going to be better positioned to keep up with this inflation because they have things like sales tax, income tax, and perhaps local option taxes. So of course, always making sure we're not comparing ourselves to others. We want to be apples to apples will be a little bit important in this case because of our reliance on the property tax. Another important point is to keep in mind that government budgets are what's considered in economics as counter-cyclical, meaning our demand for public services are often increased upon when we see the economy slow down. So while we're going to see the inflation cause a decline in the consumer spending, resulting in decreased revenue that could potentially be tax revenue, we're also going to see our citizens perhaps need more services. That could be our health and human services budgets. That could be an increased use of park spaces and recreation programs because they're looking for less expensive alternatives. That could be increases. Maybe people aren't going to rent a dumpster and have that service or a garbage pickup anymore in towns with transfer stations, and they're going to start to use the transfer station in your local community. So there's different demands that we typically see when the economy slows down. So when we develop our budgets, there's two types of strategies most of us go toward, and it could be a combination of both, but we have our level services budget, which usually happens when we're in more favorable economic times, and a level funding budget. And I would say many of us combine those two strategies in order to bring forward our budget to our voters, the proposed budget to the voters. So it's really important to note that, of course, a level services budget in times of inflation that we're seeing, that is going to see significant increases, as it's probably very obvious, to have the same goods or services delivered to our communities. In a level funding budget, if that's the target where we don't want to increase what we are proposing to our residents at time of town meeting, we're probably going to see automatic cuts have to be made. So again, most of us are going to combine the two, but it's probably important to really dive in and figure out what strategy that you're going to look to use. I will have to say school districts, for example, almost always have to move toward level service budgets. Can't really cut some educational programs out of the district curriculum that are required by law. That's one example. We can't cut snow plow services. When it snows, we have to plow. So those are level services. So I would encourage everyone to rethink the budget development process that you're going through and undertaking at the moment. So traditionally, it's most common that we use the incremental line item budgeting strategy. And that's basically taking last year's budget and with some changes around the margin, making it next year's budget. So because our budget is a political instrument and it's weighing our policy priorities against whatever available resources we may have, it really becomes a statement of our values. It's a value statement of the community. So other strategies include zero-based budgeting if you haven't tried it. So building a budget from zero. And one strategy is to do it department by department, 1 year at a time. So maybe 1 year, and I'm not picking on anyone, is the highway department, 1 year is the police, 1 year is fire, for example, so that it kind of, the zero-based budget gets built in over time. And it's a larger undertaking. However, it can have a lot of value to see that, do we have some lines that are no longer being used or being underutilized, overutilized, really paring down and seeing what it is that we need to be providing in those individual budgets. And that's when priority-based budgeting and performance-based budgeting strategies can come in. Priority-based, of course, is based on the community's priorities. What is really important to that community? And if people come out at town meeting and they vote for it because that is what they believe is important in your community, then by all means, that should be in the budget. That's, the citizen engagement and community engagement is a very important part of priority-based budgeting. And then performance-based budgeting, we see we're budgeting for direct outcomes. So we see this with health and human service budgets, with certainly school budgets, making sure that how the resources are used and measuring them against measurable outputs. So the performance-based budgeting can actually be applied to almost all areas of government, believe it or not. However, it's often more associated with, again, those service-based programs in municipal government. So one of the key concepts to look at is forecasting the revenues and expenditures and cash flows. And you're all going to say, yes, Kathrine, of course we do that. But I would really encourage you, especially in the uncertain economic times that we're facing, to look at some historic data and go back 3 to 5 years. Look at your revenue from the last 3 to 5 years. Look at what we're predicting right in the future and compiling that against expenditures over the last 3 to 5 years, and pull out any trends that you're seeing, whether it's department by department or category by category, but really using the data to support your decisions is going to be extremely important. It always is, but more so now than ever. And then conducting a cash flow analysis. We'll get into why that's going to be even more important in some subsequent slides, but making sure that you have sufficient cash liquidity to meet your disbursement needs and limit any idle cash that we can invest is going to be tremendously important, because as we enter these inflationary periods, as you're already seeing your electric bill and your fuel bills going up, and we're headed into heating season, that's going to put a pressure instantly on your cash flow. And where does your cash flow shake out? So these are some important concepts. And we do have a broad variety of members on this call. So I do want to start at some simple concepts and also get into some more complex topics. So in that cash flow analysis, it's going to be very important to identify if there's periods of excess funds that we can invest in. We're going to have to maximize on those investments right now more than ever. Certainly have a portfolio that is structured to meet your cash needs and demands, and anticipate if short-term borrowing is going to need to happen. So, of course, estimating deposits, inflows, and outflows. I do have a cash flow forecast worksheet available in Excel. It's a simple document. You don't need to make it more complex than it needs to be, but I do have that. So you can email me if you're more interested in learning about that. I can send that over to you. And certainly really checking on our outflows. As I said, we're going to have an increased demand instantaneously in some of our month-to-month costs. That's going to put a huge pressure on our cash flow. And do we have sufficient cash to cover is going to be an important question as we look at a typical municipal cash flow cycle. Now, of course, this is based on a calendar year town. I guess right? Because you're seeing December having the highest, in November and December having the highest rate of revenue come in. The yellow line is their cash flow. The orange line is our town receipts. And that orange line you're going to see in July and December being the increases because of the tax collection. We have the school payment in there because that's one of the largest obligations, if not the largest obligation that we have monthly, if that's our structure with our payments, if not quarterly or whatever the municipality and school district have agreed upon to pay that obligation. And then we have our basic town expenses in the gray line, which we usually see a typical uptick in expenses in August. However, we're going to start to see that uptick starting right here now and moving right into January. So do we have adequate cash on hand to cover? And then we're going to look at our town receipts, our cash receipts. What are our receipts looking like? And we're going to talk a little bit more in depth about some of the analysis we can do around our revenue. So of course, our revenue should talk about when we forecast it, how we're building our budget. And I've heard many times people say, well, we can't really do much about revenue. Well, I would agree that certain types of revenue are a little bit out of our control. Really looking at the data and seeing if there's any trends that we can pull out of the data are going to be tremendously important when we look at what our resource availability becomes, and the sustainability of some certain policies, programs, and services that we're offering in our communities. So the GFOA actually has a great quote, and it says, in the absence of a formal forecast, a common assumption is that the future will not be much different than the past. And that assumption could be seriously flawed. And I couldn't agree more. Just because we're in a stable place today doesn't mean that position couldn't change significantly and quickly over time if we're not looking at all the different data points available to us. So our revenue sources, education funding, highway block grants for municipalities, meals and rooms revenue, environmental grants. So these have a big question mark next to them. We're entering into a state budget year. So the legislature will be working from January to June to provide a state budget to move forward. And in that budget will be these types of revenues for municipalities. With that said, we won't know as we're developing this budget what January 1st of 2023 might look like. So we have to forecast that, and we'll get into that a little bit. And then on the municipal revenue side, property tax, interest, motor vehicle collections, all of these solid waste fees, recreation fees and revenue, utility fees. These are all areas that we need to analyze to see if there's any trends. So in the chat, Tim put in a survey that was created to kind of help you pare down on all of the different questions you can be asking yourselves about revenue. And it'd be very helpful if you turn it back into NHMA, but if for no other reason, it's going to be great data for you to analyze in your municipality for any trends. So when we look at a state revenue, such as meals and rooms distribution, the positive news is the formula has changed. The legislature has given us 30% based in a dedicated fund. And last year, the actual revenue we saw was $100 million shared through the municipalities based on population. This year, it's $121 million that will be shared out to municipalities based on municipal populations. The reason why I'm bringing this up is because, well, it's a new formula. It's extremely advantageous. The legislature really increased its revenue share. It was up 45% from last year and 55% this year over prior years that was in the budget. We're going to have to track it ourselves a little more closely. And I have provided the link right into the presentation where we can look at the revenue reports, and tracking the monthly revenue is going to help us understand where we might shake out at the end of the year. Because the new formula is based on the actual meals and rooms tax collected, we won't know until the end of the fiscal year, which is June 30, what that might look like to municipalities. But we can track it ourselves. And clearly, we can look if it's above plan, at plan, where it's coming out in the prior year. All of this is contained in those reports. So that's something we can do on our own. The New Hampshire retirement system, it's another area where we can see that we did get a 7.5% refund on our retirement contributions. The DRA has those numbers, and you can see them to apply to your tax rate right now. So that's very exciting. That's about $26.7 million that went back to municipalities. And we also see a trend that the new rates came out based on the actuarial evaluation, and those rates are trending down. But what is a competing idea is that while our employer contribution rates might be down for these classifications, which is fantastic news over the next 2 years, if we increase salaries because of inflationary pressures, we're going to see those pensions increase. So while you're budgeting, it's really important to note that as soon, if you pull one lever, like increasing a salary to retain an employee, which is extremely important in this current job market and what we're experiencing as governments and local governments, that really could negate some of the decrease we're seeing in the new rates, for example. So just really something interesting to point out. So our municipal revenue estimates. What we typically look at is, are our revenues tracking equal to or above the estimates in the budget cycle? So we look at our report and say, yep, our revenues are, tracking or not tracking. But it's more important to start asking some more detailed questions and the whys. So what's your collection for taxes compared to prior years? Are we seeing a decrease due to some of the measures and circumstances that Natch and Chris talked about? Home mortgages being more expensive, inflation impacting our residents. Are we seeing people, unable to pay their tax bills due to increased home values in general? What percentage are self-payers versus escrow? And why would we ask ourselves that question? That's a great question, because our self-pay is typically could be a more vulnerable population to paying their tax bill. If we know that 70% of our taxes are paid through escrow, you're guaranteed 70% of that income coming in. The banks are not going to default most of the time on any type of tax payment. Is there delinquencies, or are you seeing a trend in increased delinquencies to your utility payments, water, sewer, for example? Are you seeing foreclosure notices in your community? These are important questions to ask as we're developing the budget. Same with abatement applications. You can look online to see where it's usually reported if home sales are slowing, which Natch has reported is happening statewide, but there's still some hot markets depending on where you live. Motor vehicle registration, is that tracking at or above plan? I think this is a critical area to look at, because our town clerk tax collectors bring in a consistent revenue stream month over month over month in that area. We're seeing car prices be at all-time highs. However, the availability of new cars is way down. So if we're registering older vehicles, that revenue could be decreasing. We rely on that consistent revenue as we wait for the 2 tax bills to go out. I believe there's a couple of communities that are quarterly and a few communities out in New Hampshire that bill the quarterly payments, but typically we have, 2 bites at that apple. So we really do rely heavily on those motor vehicle registration revenues. And where is it tracking in your community? And when is the last time you really looked at your fees across all departments to align with the cost recovery goals? Looking at whether it's recreation fees, transfer station fees, your planning and zoning board fees. Those are examples of, is that tracking with inflation? And it's just a local policy decision on if in fact there's anything you want to do about modifying those fees. So another key concept in understanding our fiscal condition, once we're really looked at our revenue condition and forecasted it, but before expenditures can be determined, I'd be curious to know about how many people conduct fiscal capacity or fiscal condition testing, looking at different environmental factors, organizational factors, and fiscal conditions very specifically, like revenues, expenditures, and debt service, to figure out what your community can actually afford to be taxed, right? What's the affordability of what you're proposing? It doesn't need to be an overly complex system. I do have some templates on this as well. However, it's very important to look at things like your community profiles. There is a link right at the bottom of the slide, and you can click on it and look up your own community, and it'll tell you things such as your economic conditions, personal and employment information, your population numbers. These are all things that are really important to start to look up. In addition, the median household income, which we heard great news in New Hampshire, has been growing, and New Hampshire's economy has remained strong throughout the pandemic and post-pandemic, which is extremely positive news. We're one of 10 states that's really staying strong so far. So we are ahead of the curve in that area. That link in the slide that you've already received or you will be receiving does contain town by town your median household income. So it's really important to start to look at those types of factors as you're building a budget, and then start to track that data and compare it year over year to see any trends as we're developing our expenditures. So this is an example, and I do have a little caveat in my previous life when I owned my own consulting firm. This is an example of a community that is not in New Hampshire, but this is a real life example. And they wanted to really understand what it would cost to provide 24-hour police protection in their community. And what they did was look at what many of us look at, a percentage of a particular category, such as salaries. And at that time, 72% of their budget, municipal budget, was based on salaries and benefits. And they said, well, it's going to go up to 76% if we add 24-hour police protection. But when we did the costing analysis and the per capita analysis, this is how it shook out. And they were quite surprised to see that it was going to be $19 basically per person to start offering 24-hour police protection. So again, I would encourage anyone who's looking to expand services, which is extremely warranted, especially again during those uncertain economic times when there might be an increased demand for municipal services, to really cost the project and maybe do a per capita analysis rather than just the percentage of the budget in one category analysis, because you're going to see a very different number. And as you can see in this community, things like library services and parks and recreation, anything under $1 didn't make this chart, for example, but was really important to this community. And it really is up to the local community to decide, but it paints a very clear picture of cost, especially when introducing a new type of service. Oftentimes school districts do per capita or per pupil, I should call it, per pupil services, and look at the cost per pupil when they make a change to really understand the impact that's going to have on each individual student. So I would say that's a great way to understand the general cost of your services, and it's another way to look at it. So the expenditure analysis, we're having different options to measure inflation. Natch and Chris went over a whole bunch of them. So I did want to touch on, these are the different indices and they all have a different function. So use the right tool, right, for the right job. So the producer price index, for example, measures the price of commodities. Consumer price index, CPI, is often used for cost of living adjustments. So that's good for COLAs and salaries. The construction price index would be more relevant when we're looking at highway projects, for example, or really doing a large municipal project. So these are the types of areas that we would want to focus on the right index for the right job. So at the bottom, the municipal cost index is published by American City and County Magazine. You have to sign up to be a member to access that indices, but it is free. And that does carry several of the indices within the municipal cost index. So again, the education price index, EPI, is another index that schools could use. And the gross domestic product, GDP, different indices, right tool for the right job. So I think that's rather important. The other strategy that we can use is rank and prioritize expenditures like we would in our capital planning, and create a predetermined, clear, objective set of criteria to evaluate our projects to promote procedural justice when we're allocating limited resources. If you're looking at providing a level funded budget, for example, or you're looking to make cuts. This does ensure that making sure our assets are maintained, of course. And then if there's an asset, program, or service that's in the budget, but really no longer fits the community, maybe it can be retired or discontinued, or the resources redirected. And in capital planning, we use things like establishing a priority order, the need versus want categories, or we have aggregate need ranking, and perhaps a scoring scale. So on this slide, you can see several of the different models that you could use perhaps to rank your projects or your services depending on the need, like required by law or public health and safety. So if there are cuts to a budget, you have a methodical way to go about doing it that has more objective measures involved. That'll be important. And then, of course, we have our debt consideration. So federal policy makers have responded to inflation by raising the rates. And you can see the 20-year bond in the July sale on 7/13 was 3.38%. So of course, this is a cost increase on top of our already increased costs with our contract services and materials, goods, or equipment. But I would, as we are a little bit unsure, there's also weighing against the future cost of deferment. And I think that's an important consideration, because the cost of debt now versus if we don't do the project now, and we defer it, it's only going to cost more later. In my region, there's a project that was bid out about $500,000 a year and a half ago, and now it's up to 900,000. So what is the cost not to bond the project and move forward with it if whatever you're trying to correct or move forward with might deteriorate, require further maintenance, or just prices in general continue to increase? So we have to do that analysis before we decide, oh, debt is a little expensive right now. We really want to make sure that we weigh those options. And then, of course, doing our investment review. We are required to review our investment policies annually. As per statute, the treasurer shall invest in any excess funds. That is part of New Hampshire state law. And the trustees of the trust funds have similar obligations. It doesn't mean that we can't look at our investment policy multiple times during the year. So I would really encourage anyone who might have done that over the summer, as we're seeing this changing market, to really go back to their policy, review their investment policy, and make sure their primary objectives can be accomplished through safety, liquidity, and yield in that order, and review all the different objectives that you currently have, your standard of care, your risk tolerance, any procedures that you have, or how you work with different financial institutions to move those investments forward, because we're going to have to capture every dollar that we can in a higher interest rate market on the investment side and really get into that cash flow and find the times that we can afford to invest our additional funds to maximize on that yield. And then, of course, everyone's favorite topic is fund balance. It's going to be extremely important to do that cash flow analysis, look at our revenues, and make sure that we have adequate fund balance going into a time that's economically uncertain. If we don't have adequate fund balance, our cash flow is going to become under stress, and we might have to issue short-term debt to cover the gap, which also has a cost as well. And it also would allow for making sure we have funds to invest if we have adequate cash flow in hand. So in this example, our revenues, our expenditures, making sure that we start with a healthy cash flow and fund balance is going to be very important to make sure that we can cover our expenses. So it's going to be very important in general that we keep in mind our long-term goals when developing this budget. Look at our policy priorities moving forward. We have to keep the lights on. We have to turn the heat on. There's some real necessities that our individual citizens are going to become faced with, making these choices, as Natch talked about, with the housing market being what it is, with the rental market being what it is. Make sure your welfare or your assistance budgets for health and human services are going to be adequate. If you're starting to see trends like town clerk receipts being down, tax payments being down, interest on penalties and liens being up, these are all indicators that you're starting to experience fiscal stress. So with that, I don't see any questions. I know you've spent a long time with us on this webinar, and I don't want to keep people longer than they have. And I want to thank you for your time, and I'm going to turn it over now to Tim.
Thank you, Kathrine. And this still gives our members time between now and the end of these upcoming event promotions, time to put questions in the Q&A function box. But on Wednesday, November 9th, we do have a representative from the New Hampshire Housing who will be talking specifically about the Homeowner Assistance Fund and how this program can help struggling homeowners in your city or town. Next slide, please. Can you advance the slide? Yeah,
I'm trying. I apologize. Thank you.
Oh, that's okay. I know you could do it. Thank you, Kathrine. We do have, and we do hope that all of you will be joining us on Wednesday and Thursday, November 16th and 17th for our 81st annual conference at the DoubleTree by Hilton, Manchester Downtown Hotel. We have over 50 programs, close to 85 exhibitors and vendors, and we hope you, our members, will be there as well. Next slide, please.
I do want to remind everybody that all this information and a copy of this webinar will be sent out to you as registrants and attendees.
As we do with every webinar. Thank you for that, Kathrine. And if you haven't enjoyed enough of what Kathrine has been dishing out, please come back and join us for December 1st, when she will get into a little bit more detail about developing and adopting effective policies and where to start. And if you can advance, thank you. And NHMA's Executive Director, Margaret Burns, and myself will give you a full walkthrough of all the membership benefits, including some free resources that are available to you as both full and associate members. So we hope that you'll join us on Wednesday, December 7th for that program. And lastly, again, if you've not had enough of Kathrine, we are going to be promoting her for the entire month of December before she gets over to the legislature. But on December 14th, we have a program with Kathrine and with representatives from the New Hampshire School Boards Association and Natch who will talk about default budgets and how they work and where to get started. I think Natch will also wish for me to alert you that there will be an article in the upcoming Town and City regarding default budgets. And I also want to remind you that there will be an article on the Homeowners Assistance Fund, as well as a full page flyer in the January, February issue of Town and City, the November, December issue, excuse me, I'm jumping the gun, of Town and City, which will be coming out shortly. So with that, I think we are done. No more questions. Thank you, members, for sticking through the entire program with us. We appreciate your support. Great job, Chris Pelletier. Great job, Natch Grays, Kathrine Heck. What a wonderful presentation. Appreciate what you've done for us today. And thank you for joining us today.
Thank
Thank
you.
you, everyone.